As of this week, interest rates are once again making headlines. Some economists believe the Federal Reserve could lower interest rates later this year if inflation continues to cool. Others think rates may stay higher for longer. And if you're carrying debt, you're probably wondering, what does any of this actually mean for me? Should you refinance? Should you pay off your credit cards first? Should you use a HELOC? Or should you just stay the course? Now here's the thing. Most people look at debt as one giant number. I owe $50,000. I owe $100,000. But that's actually the wrong place to start, because not all debt costs the same. Not all debt behaves the same. And not every lower interest rate actually saves you money. Today we're going to slow this down. We're going to look at where interest rates actually are, how different types of debt work. When using a HELOC might make sense, when it absolutely might not. And one mistake that keeps millions of Americans trapped in debt even after lowering their interest rate. Here's where we're going today. First, we're going to look at today's borrowing costs and why one family's debt can look completely different from another's. Second, we'll talk about why simply moving debt from one loan to another doesn't automatically improve your financial situation. Third, we're going to walk through a real-world example of when using a HELOC could reduce interest costs and the hidden risks that often get left out of the conversation. And finally, I'll show you why the biggest factor in getting out of debt usually has nothing to do with interest rates at all. Because folks, sometimes the math is right, but the outcome still ends up wrong. Let's dive in. Most people think debt is debt, but that's not how lenders see it. Every loan has its own rules, its own interest rate, its own risks. A mortgage you locked in a few years ago at 3% is completely different from a credit card charging 25% today. An auto loan behaves differently than a student loan. A HELOC behaves differently than both. And understanding those differences is the first step toward making smarter financial decisions. Now let's slow this down for a second. People often think of debt as something they own, but debt is really something they rent. Think about renting an apartment. Every month you pay rent because you're using someone else's property. Money works exactly the same way. Interest is simply the rent you pay for using someone else's money. Now here's where it gets interesting. Some money is cheap to rent, some money is incredibly expensive to rent. So before asking, how much do I owe? Maybe the better question is, how much rent am I paying every month to borrow this money? Think about that for a second. That's a completely different way of looking at debt, because two people can owe exactly the same amount of money, yet one family pays thousands of dollars more every year simply because their interest rate is higher. And that's why understanding the cost of debt matters just as much as understanding the size of the debt. Now here's the number worth paying attention to. American households collectively owe trillions of dollars across mortgages, auto loans, student loans, credit cards, and home equity loans. But those debts aren't growing equally. Credit card balances remain elevated. Many borrowers are paying historically high interest rates. And after years of decline, more homeowners have started tapping their home equity again through HELOCs. Why? Because many people are sitting on mortgage rates of 3 or 4%. And they don't want to refinance into a brand new mortgage at today's higher rates. So instead, they're borrowing against the equity they've already built. That doesn't automatically make a HELOC good or bad. It's simply another financial tool. The important question is, when does that tool actually help? And when does it create more risk? That's where we need to look beyond the headline interest rate. History doesn't repeat perfectly, but it often rhymes. Let's go back about 20 years. Debt was much simpler. Mortgage rates, auto loans, credit cards. The gap between those borrowing costs wasn't nearly as wide as it is today. Today, one household could have a mortgage at 3%, a student loan around 6%, an auto loan around 8%, a HELOC around 7 or 8%, and a credit card charging 25%. That's a huge spread. And every one of those loans behaves differently. Some are fixed, some are variable, some are secured by an asset, others aren't. And that's why simply saying, I want a lower interest rate, doesn't tell the whole story. Because lowering your interest rate sometimes means changing the type of loan you're carrying, and that changes the risks. Now here's something else that's important. When the Federal Reserve changes interest rates, not every loan changes the same way. Mortgage rates often move with longer-term Treasury yields. HELOCs are commonly tied to the prime rate. Credit cards often adjust even faster because many have variable interest rates. So when people say, the Fed is cutting rates, that doesn't necessarily mean every borrowing cost immediately falls. That's one of the biggest misconceptions I hear. Imagine you've built up equity in your home. You also have $35,000 sitting on a credit card charging more than 20% interest. Your bank offers you a HELOC around 7 or 8%. On paper, that sounds fantastic. And mathematically, it often reduces the amount of interest you're paying every month. That's real. If less of your payment goes toward interest, more of it can go toward reducing the balance. But here's the part that almost nobody talks about. Lower interest only helps if you actually use those savings to pay off the debt. Let me show you what I mean. Suppose you've been paying $900 every month toward that credit card. After moving the balance to a lower rate HELOC, maybe the required payment drops to $600. Now you've got a choice. You can lower your payment, or you can keep paying the original $900. Every single day, your money is losing ground. Inflation is eating your savings. Debt is draining your income. And the financial system? It was never designed to work for you. But there is a way out. And the wealthy have known about it for decades. I'm hosting a free live training where I'll show you exactly how to eliminate debt like the wealthy do, how to preserve and protect your capital from the forces working against it, and how to build a clear step-by-step path toward true financial freedom. No gimmicks, no fluff, just a proven system that puts you back in control of your financial future. Seating is limited and it is completely free, but you need to act now. Click the link below or scan the QR code to reserve your spot today. The wealthy don't wait, neither should you. Now let's get back into the video. Folks, that's where financial progress is made. If you keep paying the $900, the extra $300 doesn't disappear. It goes straight toward the principal. That means your balance starts falling much faster, which means next month you're paying interest on a smaller balance, which means even more of your payment attacks the principal. And that's where momentum begins. The lower interest rate didn't eliminate the debt. Your behavior did. The lower rate simply gave you the opportunity. Now let's look at the other side of the equation, because every financial decision has trade-offs. Let's use that same homeowner. They've got equity, they qualify for a HELOC, the interest rate looks lower, everything seems to make sense. But here's what many people don't realize. A HELOC isn't simply a cheaper credit card, it's a completely different type of loan. Most credit card debt is unsecured. That means if you stop making payments, the lender has limited remedies compared with a loan backed by collateral. A HELOC is different. It's secured by your home. Think about that for a second. You've changed more than the interest rate. You've changed what stands behind the loan. That doesn't automatically make it a bad decision, but it absolutely makes it a different decision. Now, here's something else many people overlook. Unlike many mortgages and unlike many auto loans, HELOCs often have variable interest rates. That means today's rate may not be tomorrow's rate. If borrowing costs rise, your payment could rise as well. So imagine someone comparing an 8% fixed auto loan to a 7% variable HELOC. On paper, saving 1% sounds like an easy decision. But if rates increase, that 1% advantage could disappear, or it could even reverse. That's why comparing interest rates alone doesn't tell the whole story. You also have to understand whether that rate can change. Now, let me be clear. Banks aren't offering HELOCs because they're trying to lose money. They're offering them because home equity is one of the largest financial assets many families have. When you borrow against that equity, the bank receives another secured loan. That doesn't make the bank the bad guy. It simply means their incentives are different than yours. Your goal is to reduce debt. Their business is lending money. Understanding that difference helps you ask better questions. And here's one more thing that often gets left out of the conversation. Opening a HELOC isn't always free. Depending on the lender, there may be an appraisal fee, title or recording fees, application or origination costs, annual maintenance fees, or even early closure fees if you pay the loan off too quickly. Some lenders waive many of these costs, others don't. The point is simple. Don't compare only the interest rate. Compare the total cost of the loan, because sometimes the cheapest looking loan isn't actually the least expensive once every fee is included. Here's what most people missed. The biggest factor in getting out of debt usually isn't finding the lowest interest rate. It's changing what happens after the interest rate goes down. Let's say refinancing saves you $250 every month. Most people accidentally treat that like a raise. Maybe they eat out a little more. Maybe they buy something they've been putting off. Maybe they simply lower their monthly payment because it feels easier. And before long, they're still carrying almost the same amount of debt. Now imagine someone else does the exact opposite. Every single dollar they save in interest goes immediately toward the principal. Now something powerful starts happening. Their balance drops faster. Next month's interest gets smaller, which means even more of the payment goes toward principal. And that cycle keeps accelerating. That's how momentum is built. Now here's something else that doesn't get talked about enough. Credit card companies calculate a minimum payment designed to keep your account current. But staying current isn't the same as getting out of debt if you're only making the minimum payment. A large portion of every payment is often going toward interest first. The balance shrinks very slowly. That's why lowering your interest rate only creates an opportunity. It doesn't guarantee a better outcome. Folks, you can make a decision that's mathematically correct and still end up financially worse off. How? Because math tells you what could happen. The lower interest rate didn't solve the problem. The habits never changed. And I honestly think that's one of the biggest lessons in personal finance. Interest rates matter. Loan structures matter. But your financial behavior matters even more. Now, as of this week, here are the reports I'll be watching. The next Federal Reserve meeting, the Consumer Price Index, the Personal Consumption Expenditures Report, the Consumer Credit Report from the Federal Reserve, and the next Household Debt and Credit Report from the New York Fed. Each report gives us another piece of the puzzle. No single report determines where borrowing costs go next. But together, they help us better understand what's happening throughout the economy. If interest rates begin moving lower, we'll continue watching which types of loans respond and which ones don't. Because as we've talked about today, not every interest rate moves the same way. Folks, before you move debt from one place to another, I want you to remember 4 simple questions. Number 1, is the interest rate actually lower? Number 2, is that rate fixed or can it change? Number 3, what fees am I paying to make this happen? And number 4, what am I honestly going to do with the money I save every month? If the answer is, I'm going to spend it, probably haven't solved the problem, but if the answer is, I'm going to put every extra dollar toward paying down the principal, now you're changing the math. And more importantly, you're changing your future. Because financial freedom rarely comes from finding the perfect loan. It usually comes from consistently making better decisions. What's your take on all of this? I'd genuinely be interested to hear your perspective, so down in the comments, let me know what your thoughts are. And if you found this episode helpful, make sure you like this video and also subscribe to this channel. Every single week, we break down current economic events, market trends, and historical patterns to help you make more informed financial decisions during uncertain times. Thanks again for joining me on this episode of Straight Talk. And with that being said, I'll see you next week.